Back on Morning Movers, GE shares up nearly 10% to start 2025, and the company reports earnings tomorrow morning. Analysts are expecting adjusted EPS of $1.26 a share for the first quarter, revenue of nearly $9 billion. Now, the stock is off from the more than 15-year high. It hit in February, down more than 15% from that high. Time now for Options Corner. Joining us to take a deeper look at GE, we've got Rick Ducat, lead market technician. All right, Rick, it's been quite the story for this company. What trends are you seeing on the chart?
Well, for starters, outperformance versus both the broader market and its own sector. You can see the XLI ETF up 3.2% during the past year, while the S&P is up 5.4%. GE up 21%. So a significant degree of outperformance here. Now, if we were to look at our chart more specifically, we can see that we have backed off from those highs. As you said, we had a double top type situation here around 210. We did make some progress up to 214.21. Before eventually falling lower here. We had this kind of M-shaped price pattern here that brought us back to this green line that represented a low point from all the way back there in August, and then once again here in December, then most recently here. So around 160 or so was a crucial point for this stock to hold, and indeed it did here at that supportive level. You can also see we do have a more gradually sloping white trend line going upward. That was kind of around where the closing prices matched up versus the intraday prices. So that was another key area to look out for if we were to keep moving lower. Now we can see that this red line here represented the high point after a gap up, several subsequent highs and lows, and then some consolidation here. So 185 seems like a notable area as well for the bulls to progress over. So if we were to look at our volume profile and standard deviation channels, our green line lines up with the point of control near about 160 or so. So that would be an interesting area to watch. And then to the upside, another volume node here near about 203.
All right, Rick, thanks a ton for the insight on the chart. Time now to take us through an example trade. We've got Tom White, senior options contributor, co-host of Fast Market. So, Tom, how would you go about an example trade for this one, especially with earnings in front of us?
Well, implied volatility levels in the near-term options are really elevated going into this report, not surprising. On that, and as Rick mentioned from the charts, this stock has outperformed over the past 12 months and so far this year, still up about 8% in 2025. So it's had a pretty good run. So I looked at a strategy that takes advantage of volatility dispersion, which we have a lot of in this name going into the report. The option market pricing in about a plus or minus 6% move in the shares, or about $10 either way as of Thursday's close. So I looked at it that way in a regard for how much this stock could potentially move, what the option market's pricing in. So I looked at something a little bit more bearish. Maybe there's contrarians out there that think maybe this stock's outperformed and maybe it shouldn't. Tariff impact is going to have some headwinds for this company moving forward, even though it's done relatively well. So I looked at a bearish put diagonal where I'm going to go out to the May 2nd weekly cycle, so 11 days to expiration. I'm going to buy something at the money. The stock looks like it's going to open up about 180. So we'll buy the 180 put in that May 2nd weekly cycle, and then against it in the near term, April 25th weekly options that expire in just 4 days, we're going to sell the 170 strike put. So a bearish $10 wide put diagonal. And if the stock opens up about 180, you're going to pay about $4.80 for it. So less than half the width of the put diagonal. So why is it costing less than the width of the put diagonal? Well, that's because of volatility dispersion that we have in here. You're buying about a 58% implied volatility on that 180 strike in the May 2nd option on that put, and then selling about a 77% implied volatility on aggregate in that April 25th weekly 170 put. So that creates that vol dispersion, lowers the price entry point in your risk on this, which is the debit you pay, about $480. Anything below about the 178 level is going to be profitability on this one. So you don't need a massive move to the downside, but if you think that GE post-earnings is going to start to slide, maybe give up some of those gains that we've seen so far this year, this strategy takes advantage of that.
All right, and GE shares right now lower in the pre-market, along with the broader market pressure that we're seeing. Thanks a ton, Tom, for that example trade.